All right, we are live with Jeff Loveland at OneTrust. Jeff, how you doing, man?
I'm doing great, Alex. Thanks.
So stoked that you're here with me today. We were on a call last week, I believe, and you had an idea for talking about people who buy their home. Usually, they're getting in and qualifying at the lowest tier, and then they just kind of let their credit go. They kind of forget about it, and how damaging and problematic that could be. And so I was stoked. I wanted to get on a call with you right away to talk about it, and I think that you've got some really great information. So
Yeah,
if you're cool with it, we'll jump right in.
let's do it. Yeah.
Awesome, man. Well, kind of to draw off of what you had originally talked to me about, why should new home buyers even worry about their credit after they've been able to get into their home?
Sure. Yeah. I mean, besides the overall fact, I know you know this being in the business, that it dictates so much and not just the home buying, right, but so much of your life. But yeah, like specifically on the home buying, that you have other opportunities, refinancing or buying the next home. And specifically for these clients that have done so much work, and I know you see it, they claw and scratch and fight their way back to where they can qualify for a home. I really, it breaks my heart to see them when they get back into those habits and now they have to start from scratch again. So keeping that and turning it into a habit, rather than just something you do one time to get into the house, will help you with more opportunities, and you potentially save money on your house with a refinance or get cash out with a refinance. And not only that, like I said, so much more savings across the board if you're looking at it from a holistic view of like your car payments. Those will go down. The next car that you or your spouse buys will be down because you've practiced these good credit habits. And now you get the best interest rate possible on your car or even on your credit cards or whatever.
Yeah.
So that's why it's so important to keep those habits in place and not just do them to buy the home, but continue to do a good habit of paying your debts off, making sure things don't go to collections. So
Yeah. And this would be something interesting that we should probably look up. But most people, when they buy their home, they're not in that home for 30 years, right?
No. And what I look up is the mortgage side, right? That's the part that I'm interested in. So statistically, you're going to be in your loan for 5 to 7 years, right? So that's the national average, because your family's going to grow. You're going to sell the house and buy a next one or buy a bigger one or what have you, or you're going to refinance because rates have dropped, or you want to, pay off some debts that you've accumulated. And so you'll do a cash out refinance. So you're going to get out of that loan or get away from PMI, all things that happen lead to that average of 5 to 7 years.
Yeah. That's interesting to me because I think a lot of people go into it with this very long-term perspective, and then they're in the home for 3 or 4 years and they think, oh my gosh, I got to go through this whole thing again, right? I got to go through trying to build my credit or resolving credit challenges. And I think one of the big problems that people have is there are pitfalls post-closing, right? Like there are pitfalls that people kind of get trapped in after they close on a home. Wouldn't you agree with that?
Oh yeah, wholeheartedly. I think some of the pitfalls that I've seen, and maybe you can weigh in on it as well, but some of the pitfalls I see are people get into their home and they want to spruce it up, and I that's great, but they don't hesitate to swipe that card, right, and get into some debt. And so that's one of the big things, because and it's so easy nowadays. You have things like Pinterest, like, oh, you know what? We need to redo all the carpet. We need to do the paint. We need to do new appliances, whatever. I mean, those 3 things right there that I just listed off, we're talking, depending on the size of your home, $10,000 to $15,000 to $20,000 easily, right? And so that right there has been one of the biggest pitfalls. For whatever reason, there's also this thing in your mind. You got a brand new looking driveway and it needs a new car sitting in front of it. I don't know why, but it happens. So
yeah. Hey, I've done that. When I bought my first home, I think I went and bought a car within like a month.
Yeah.
Yeah, it's dangerous. I think that debt traps are serious. People go out and they don't recognize that maybe they have a higher monthly expense with their mortgage. They go and they add and they add and they add, and then next thing you know, 2 or 3 years down the road, they haven't been able to make progress. They've actually gone backwards. Maybe they missed a payment or they had some medical expenses come up that didn't get paid because they had to pay on something else. I mean, these things are very real for people. And so if you can show a little bit of restraint after getting into a home and maybe put together a plan before you go purchase that couch or that car or whatever that is, I mean, that's usually the smartest way to go about it. But again, it's hard. You got that empty driveway, man. You want that.
Yeah. Yeah. Or like you said, that empty living room. You need a new couch, you need a new TV. That was my biggest thing when we bought. I needed a new TV to take up the wall space, right? It's a bigger wall.
Yep.
You need a bigger TV to show it. And it was football season, so I had to have it. So
yeah, it's easy for people to fall into those traps. But again, you're not in your home for 30 years often. Usually
Right.
it's going to be that 5 to 7 years. And so there are, a couple things that Jeff and I have discussed that we think that you can do after you close on a home to try to stay on track, because there are huge benefits that Jeff talked about maintaining healthy credit. One, lowering your PMI, right? Your mortgage.
Or eliminating it. Yeah.
Lowering your interest rates. Rates just dropped again. Being able to refinance to cash out to pay off debt. I mean, there are so many reasons why once you get your credit score up, you should really try to stay at that point. So Jeff, kind of what are some ways that people can maintain healthy credit after they close on their home?
Yeah. So, I mean, we've kind of discussed them, but to kind of summarize them all here. So keeping those credit card bills in a manageable sense, right? Keeping the balances low. I understand you have to buy things, but don't overextend yourself. You don't want to put yourself where you're getting behind in your credit cards and collections start coming and late payments, and you're going to knock your credit score. So, I mean, that's the huge thing. The next one, I would say stay in touch with your loan officer. I know we had talked about that on a call earlier. I don't mind it being a loan officer myself. If my client, in fact, I love chatting with my clients. Say, hey, we're thinking about buying this. What do you think? Great. Yeah. Are you guys financially set? Okay, cool. That sounds good. And even just having that affirmation from someone else is a helpful, or sometimes it's a pushback. Are you guys doing okay with your mortgage payment? It's been a little bit tight. Is there anything we can do to save up and buy that just cash later on and not put it on your credit card? And the third thing, like a third takeaway that I would say is let's get together and maybe even before you close, establish a plan of what your financial habits, like you said, you want to be in a habit down the road.
Mm-hmm.
One thing to kind of build off of, like you said, that refinance or get your PMI off, or you had just mentioned rates have dropped, and they have. But the fun thing and crazy thing about rates is sometimes it's a finite time. Maybe they dip down for only 30 to 60 days. So if you're in a spot where your credit you're gonna have to fight back up, you may miss out on that opportunity, right? Whereas if you're in a good spot and you call me up and say, hey, I think it's a good time. Can you look at our situation? We can jump right in it. We don't have to do 6 months of building your credit back up. So
yeah. And if you've gone through the home purchase experience before, you really don't want to have to replicate that, especially when you're trying to build up your credit, right?
Right.
The home process itself with working with Jeff is fairly simple and easy. His team's probably got one of the best processes I've ever seen for getting somebody from application to close, right? Like seamless. But you put credit repair, you put, people trying to deal with credit challenges in that process, and it's tough. It can be hard. And so if you've already gone through it, avoid having to go through it again is kind of the message here. But Jeff, I can't thank you enough for wanting to do this with me. Honestly, dude, you're so good at what you do. You're a huge advocate of helping people get credit qualified, a huge advocate of what we do. And hopefully we'll be able to help people avoid certain mistakes and be able to actually take advantage of their credit later on down the road after a house purchase so that they can continue to save money and prosper.
Yeah.
Any closing remarks?
No, thank you so much for having me on, man. I appreciate you're a huge advocate of what I do and benefiting the client as well. It's more than just a transaction. It's helping them form life-changing habits that will help them out in so many ways they don't even know. So
absolutely, my friend. Well, I'm sure we'll be doing this again soon. I hope this helped you guys out there. If you have any needs, whether it's on the mortgage side, Jeff's information will be on this post. If it's on the credit side, we'd love to be of assistance and put together a free evaluation for you. If But have a fantastic day, and I'm sure we'll be talking to you soon. Have a good one, Jeff.
Thanks. See ya.